Hello, everyone. This is Peter and Noah coming to you again. And interesting subject today, which is how to Biden-proof your taxes. And we're actually doing this program on Thursday, August 20th. And unless something really unusual happens, Joe Biden will be nominated to be the Democratic candidate tonight. So it's a very timely topic. Part of the reason for this program is Biden, although some people would say has been hiding out, he's been very transparent about what is economic and tax policy he would like to see. And so that's good for us because we can look at it and study it and think about how to react. I think the simple message is, in a pure economic sense, richer people are going to pay more in taxes.
That's a simple way to put it.
Just two quick little statistics there is that people are in the top 1% of income owners. Their taxes could go up 10, 15, some people even say 17%. So that is not an insignificant amount. If you make $1 million, your taxes might go up $170,000. For most people, that's real money. Maybe even more significantly, the statistic is that 93% of all the tax increase will be borne by only 20% of Americans. So, and those would be your higher earners, people who own more property, people who own more investments. So the reason for our program really is twofold before we get into the details. Is it's August 20th. We won't know who the president will be until at least the earliest, probably November 3rd. So now is the time to get started thinking about this. If you wait until November 3rd, you may not have enough time to think through and implement all the changes that you want to make. Now, the second simple point is everyone's tax situation, especially the tax situation for a more wealthy person, is complicated. And so we're going to kind of give you a high-level introduction to the framework here. But you really should do this in some detail with your own situation. So either reach out to your own CPA, or if we can be of help to you, reach out to us. But you should start now. So what we'd like to cover is, if you think about taxes, there are basically three main types of taxes: income taxes, estate and gift taxes, and corporate and other business entity taxes. And there are major changes proposed in each of those areas. So maybe we'll start with people first and income taxes. So Noah, why don't you give us a little overview of what some of the significant income tax changes are? And
sure.
Sitting here today, what we think some of the things you should think about doing.
Yeah, well, so there's really three significant changes. Two of them might impact people in a slight way, and that is the top tax bracket, which used to be 39.6% and now is 37%, is scheduled to go back up to 39.6% if Biden's proposal is approved. So, you know, that 2.6%, it may not sound like a big number, but again, on $1 million earner, that's another $26,000. So it's significant. The other increase that could affect high income earners is a cap on itemized deductions. So if you remember, in the last round of tax adjustments, we capped the state and local tax deduction to $10,000. So now on top of that cap, there's going to be other caps to eliminate itemized deductions for charitable contributions or other itemized deductions. So you've got to be certain, if you're in a high itemized deduction category, that you're evaluating whether or not you want to try and make your charitable gifts this year versus waiting until next year using things like a donor advised fund. But the biggest change, and really the change that people should be thinking about and planning around today, is a change in the proposed capital gains taxes. So right now, the capital gains tax and the dividend income tax are very different than our ordinary income tax rate. So I mentioned currently the highest ordinary income tax rate is 37%. Biden's proposing to increase it to 39.6. Our current highest capital gains tax and dividends tax rate is 20%. And Biden is proposing to eliminate that reduced tax rate and make it the same as ordinary income taxes. So if you were planning to sell your business in 2020 and you were going to realize a $10 million gain and pay $2 million of capital gains tax, well, under Biden's proposal, instead of $2 million, you'd pay $3.96 million. So almost double the amount of tax on that capital gain. And what does that mean for you as a taxpayer is you've got to consider if you want to realize any gains this year. And that's really unique. Almost every single time you speak with an accountant, they're going to suggest to you that if you could avoid paying taxes this year and instead pay them next year, we should push them off because you get the benefit of the time value of the money. In this year, we're going to start thinking carefully about whether or not we want to start recognizing some gains in 2020 instead of waiting until 2021. And now the flip side is also true. So often is the case that wealth management experts, one of the ways they bring value to clients is that they do what's called tax loss harvesting. And what that means is they go through your portfolio around this time of year in the fall, and they look to see where are the winners and where are the losers. And what we do is inevitably different positions will have gone down throughout the year, and they will have accumulated losses. Now, when we realize those losses, we could use that to offset any gains that we had. In this particular year, we're waiting to recognize losses. We want to wait and see what's going to happen with the election, what's going to happen with Biden's proposed taxes. We still have time at the end of the year to realize those losses if we need to, but let's not do it now. Hold on to your losses, because if your loss is worth 20% this year, but it could be worth 40% next year, let's wait and pick up that extra return.
So I think what's interesting about that, which impacts a number of the topics we're going to talk about, is something that I like to call the pivot. So today, Biden will be the nominee. We don't know for a while whether he will or won't be the president. And, you know, if you just read the newspapers, my guess is we won't know on November 3rd who the president is. Something's going to happen. So you need to think this through. It's not too early for, just on the thing Noah mentioned, is get your wealth manager or your CPA to look at your portfolio and where are the gains and where are the losses. So you're not making this up in the middle of November. You've got kind of a game plan. So if we stay with individuals, the other major, so we've just talked about all the taxes individuals could pay while they're alive. So there's an even bigger tax they could pay when they pass away, which is the estate and gift tax. Right now, there's a huge, the largest it's ever been, individual exclusion from estate taxes of just under $11.6 million. What that means is for a couple, that's 23.2 if I do the math correctly in my head. So that's a large number. So that's the law today. As written today, that number, 11.6, is slated to come back to about $6 million beginning in 2026. But most people think if Biden's elected, and almost certainly if the Congress is controlled by the Democrats, there's a chance it could come even farther down. Most people think somewhere in the 3 to 3.5 range. So, Noah, what kind of things might we think about or do if we're a wealthy person and we think that a state tax exclusion might be dramatically reduced?
So I'll tell you what my family just did in light of this perspective change is we took assets that we own and control right now, and we put them into a trust, but we didn't gift it to the trust. We loaned the assets to the trust in exchange for a note. So let's just say the assets were worth 10 million, and now the trust has a loan to me personally for 10 million. And so the trust owes me the money. That's not a gift, but the assets are already put inside the trust alongside the liability. Now, come election time, if the tax laws look like they're going to change, I can gift my note back to the trust. So I could say, I forgive this $10 million loan, and the forgiveness of that loan would be a gift.
Right.
And then I would recognize my gift, and I would file my gift tax return, and I would use 10 million of my $23 million exemption. So we can prepare for the potential that this tax limit goes down, and therefore the gift and estate tax we might face would go up, without necessarily giving up control or the rights to our assets if we're not quite ready for that. Now, if you're already at a point in your life, either financially or based on your age, where you feel like maybe the time is coming that you'd be willing to give up control and responsibility over some or all of your assets, now's a good time to start finalizing that decision. Because if you make that decision today, the government's willing to let you pass that 11.6 million per person. And if you wait until next year, potentially that limit will go down significantly and you'll be gone. That opportunity will have gone. If you make the gifts today, there isn't going to be a clawback. So even if they change the law in 2021, if you complete your gift in 2020, there's no backsies. You're fine. You're able to shelter those assets from estate taxation. And if you structure it properly, it could potentially be for multiple generations without any taxation, estate taxation. So you want to carefully consider what your financial position is today, whether or not you have the ability to make outright gifts today, or if you're not sure, like me, I'm a young guy and I still have plenty of life in front of me that I hope to enjoy. I'm not so sure I want to give away my assets, but by providing this structure where I'm making the contribution to the trust and I'm waiting for the receipt of the tax law, I could always give up that gift.
Right. So I think there's a little point in there. The main focus today is on taxes. But you said just a minute ago, if I'm comfortable giving away assets, and if based on looking at my financial plan, a lot of our clients, the reason they come to us is they're not capable of figuring that out. And it's not because they're not smart enough at all, but it's not their area of expertise. So another little seed we'd love to plant here is taxes are part of a broader spectrum of services that Freedom provides to clients. And in one sense, what you could describe a lot of that as is all the number crunching that goes into evaluating how to make sure their life works the way they want it to. So please reach out to us. It's fine for us to say, well, if you feel wealthy enough to give away $11.6 million, many people like to see that in black and white on a piece of paper. So the third major area of taxes is corporate taxes. And before we get into that, the important point here is sometimes when we say corporate taxes, I think the listener zones out a little bit because they think we're just talking about IBM or Netflix or Microsoft. In fact, a lot of those companies pay no taxes, but there are a lot of business entities, LLCs, subchapter S corporations, C corporations owned by individual business owners, where the issue of corporate taxes is relevant and the proposed changes are significant. So tell us a little bit about that remaining part of it.
Sure, and this really applies predominantly to C corporations. And if we kind of go back in history under President Obama, C corporations paid a 35% income tax rate on income. And so for most individual and closely held businesses, they did not want to be taxed under that system, because after you paid your corporate tax, if you wanted to make a distribution to your shareholders, you do that through a dividend, and you're subject to the dividend tax, which was 15 or 20%, depending on your bracket. So on a combined basis, right. So it was even more. So nobody really found owning a C corporation personally very attractive. Well, that all changed when President Trump reduced the corporate tax rate to 21%. And so now with a 21% corporate tax rate and a 15% dividend tax rate, you're still under the individual income tax rates. And it was attractive to certain taxpayers to become C corporations. I myself own 2 C corporations, and I find that there's validity in owning C corporations for certain activities. They have certain characteristics that make them different than owning an S corp taxed as a partnership. So now under Biden's proposal, if he were elected and if this proposal were to pass, he's proposing they raise that rate to 28%. So significant tax rate on the corporate income. But remember, when we started the conversation around individuals, we also said he wants to eliminate the dividend tax rate, and all dividends would be taxed as ordinary income. So now if you own a C corporation and you pay 28% tax, and then you issue a dividend to you as a shareholder and you're paying a 39.6% tax, that's not even including any state tax. You probably are not going to want to own a C corporation that's making dividend distributions under President Biden with this plan. So we want to look carefully at your corporate structure, make sure that we understand how your taxes would propose to look under the new plan, and start seeing if there's adjustments you should be making in your corporate structures to enable you to have the flexibility to shift income between a C corp and maybe an S corp or a partnership, so that you can take your money out of your business in the most efficient way.
Terrific. So I think by way of summary, if you are a wealthy individual and a business owner, it is likely that in all 3 areas of taxation, income tax, estate and gift tax, and corporation, or let's call it more business entity taxation, there are some big changes coming, potentially coming. You're not going to have enough time to figure all of those out by election time. And so now is the time to start to figure out how those apply to you. This has probably been a fair amount of information, but it's probably really only the tip of the iceberg in terms of what might really be available to you. And as with many things, there's a danger, but there's an opportunity here to be taken advantage of to reposition yourself. And so if we can be of help, please give us a call. And thank you, Noah.
Thank you, Peter.
Okay.